The doors of the Second Bank of the United States close with a final echoing thud. It's 1833. Outside, a restless crowd gathers, merchants, farmers, laborers, watching a financial institution they barely understand become the center of a national battle. Inside, ledgers sit heavy with numbers that quietly control the fate of an entire economy. In Washington, President Andrew Jackson signs an order that will effectively dismantle this bank, an act he believes will restore power to the people. But something doesn't add up. Because as the bank collapses, instability spreads, credit tightens, businesses fail, panic ripples through the system. So what exactly was destroyed that day? A corrupt institution or a fragile backbone holding the economy together? How did the United States go from fearing centralized banking power to building the most complex and dominant financial system in history? This isn't just a story about banks. It's a story about control over money, trust, and the invisible system that determines who thrives. To understand modern finance, you have to start here. The architecture of today's banking system isn't an accident, it's the result of centuries of conflict. In the late 18th century, the United States is a fragile, newly independent nation, burdened with war debt and economic chaos. There is no unified currency, states issue their own money, trade is inconsistent, trust is scarce. Enter Alexander Hamilton. He doesn't just see a young country, he sees a broken financial machine. His solution is a centralized banking system. In 1791, he establishes the first Bank of the United States. The logic is deceptively simple. Imagine an economy as a body. Money is its blood. Without a central heart to pump that blood efficiently, circulation fails. Hamilton's bank becomes that heart, standardizing currency, managing government funds, and stabilizing credit. The United States has a financial anchor. But here lies the first paradox. The institution designed to stabilize the economy immediately triggers fear of concentrated power. When the first bank's charter expires in 1811, it is not renewed. What follows is chaos. Banks begin issuing their own currencies again. Then comes the War of 1812. The government struggles to finance the war effort. Inflation surges, credit collapses. So in 1816, the Second Bank of the United States is created. It brings stability and enforces discipline among state banks. But over time, it becomes something else. Power consolidates. Farmers feel squeezed. State banks feel threatened. Andrew Jackson frames the Second Bank as an enemy of democracy. When the bank falls, the U.S. enters the free banking era. The name sounds liberating. The reality is anything but. Banks proliferate, hundreds of them, each issuing its own currency. If too many people demand redemption at once, the bank collapses. As long as trust holds, it functions. But doubt spreads rapidly. This is a chain reaction waiting to happen. Throughout the 19th century, the United States experiences repeated banking panics, excessive lending, overconfidence, a sudden shock, then collapse. Decentralization designed to prevent power creates widespread instability. The real turning point comes in 1907. It begins with the failure of a speculative scheme. Within days, it escalates. Banks stop trusting each other. Depositors rush to withdraw funds. The financial system begins to freeze. There is no central bank. So a private individual steps in, J.P. Morgan. He gathers bankers in his library and forces them to coordinate rescue efforts. The fact that one man can act as the de facto central bank terrifies policymakers. The system doesn't lack power, it lacks structure. In response, the Federal Reserve is created in 1913. This is the moment the United States finally builds its financial backbone. The Fed is a network designed to manage liquidity and act as a lender of last resort. Think of it as a pressure valve. But if banks know they can be rescued, they may take greater risks. This flaw becomes painfully evident in 1929. The stock market crash is a collapse of confidence. Banks fail, credit contracts, the economy spirals into the Great Depression. The Fed fails to act aggressively. The lesson is brutal. A central bank is not enough. It must act decisively and at scale. For decades, it works. But stability breeds complacency. By the late 20th century, banking evolves beyond traditional deposits. Securitization emerges. Banks bundle mortgages and sell them. This spreads risk, but also obscures it. 2008 arrives. Lehman Brothers collapses. The crisis spreads globally. The Federal Reserve intervenes aggressively with quantitative easing. The system stabilizes, but the paradox remains. Banks become larger, markets more interconnected. Today, banking extends into shadow banking and technology. Algorithms and fintech dominate. Understanding this history isn't about memorizing events. It's about seeing the pattern and recognizing the architecture. The financial system you live in today is an evolving machine, one that is constantly being tested and occasionally breaking.